This conference will now be recorded.
Well, good afternoon and welcome to our 9th weekly webinar. My name is Marty Curtis, and on behalf of the advisors at Provisions Wealth Planners, I'd like to welcome you to our webinar. As it is today, Governor Evers' stay-at-home order will be lifted as of May 27th, and we're in the midst of considering the potential impact of reopening from a humanitarian perspective as well as an economic impact. I think we all can agree that we need to reopen on a cautious note, and we at Provisions Wealth Planners are establishing our game plan to reopen our office. Our first priority certainly is to ensure the health and well-being of our employees and guests. And as of this point, I can tell you that when our plans are finalized, we'd be happy to communicate them with you. But we are in the process of finalizing those plans as of today. As in recent weeks, we have our guest speaker who will take about 20 to 25 minutes to present his thoughts on the current market conditions and economy, and from Luken's perspective, what investors can expect in the near term as well as long-term expectations. We have sent Greg some of your questions that we have heard from you this week. He'll address them in his comments or shortly after. Then after Greg's comments, we'll open up the lines for an additional questions from the audience if there are any. Joining us today is Greg Luken. Greg is the founder of Luken Investment Analytics, a quantitative research and asset management RIA, which is a registered investment advisor. Mr. Luken was presently founded and ran a broker-dealer, a registered investment advisor, and was founding shareholder in a web-based pricing platform for non-standardized derivative securities used by institutional trading desks. Greg authored the book, Retire with Confidence, Your Toolbox for Financial Independence, and has articles that have appeared in Forbes, Financial Advisor Magazine, Wealth Management Magazine, Tampa Medical News, and the Nashville Business Journal. He's received his first securities registration in 1988, and he's held the series 55, 27, 4, 24, 65, 6, 63, and 7, and has served as a financial advisor for 25 years. He is a member of the Forbes Finance Council and a frequent guest on financial networks such as Fox Business News, Nightly Business Report, Bloomberg Radio, and Reuters TV. Luken Investment Analytics provides research and asset management to financial advisors, and the S&P Dow Jones calculates two Luken diversification indices. With all that, Greg, welcome. We appreciate the time out of your busy schedule to share your thoughts and insight with our clients.
Thanks so much for that introduction, Marty. Hearing that, I feel like I need to have a conversation with whoever sent that bio over. I'm just amazed at how well you got all those words out. It was quite a mouthful, so I feel for you. So I appreciate that thorough introduction. And what I'd like to do in the time that we have today is make sure that we make it valuable to each and every one of you. My desire is that you walk away with a clear sense of what your financial advisors are doing for you and how they're monitoring the situation and being proactive in a time that, as Marty said, is really unprecedented, kind of we would call it a black swan event. You don't create models for what happens when all of a sudden you just turn the key off on the economy. And clearly, different parts of the country have been impacted differently. Different parts of the country are handling it differently. And so this is a very, very dynamic situation. So what I thought I'd do to make this most valuable today is go through kind of the underpinning of what we do and why we do it, and so that you have a sense of what's going on. Call it, popping the hood and looking underneath the hood and checking things out. We do have a little different perspective, and my intention is never to step on any toes. We are we have pretty high conviction in what we do, and we definitely have opinions based on the experience we've had and our indicators and the way those things have worked. So I'm just going to jump in, and then hopefully we'll have some some good sharing time together. So I want to share with you kind of the underpinning of what we did. Marty shared with you that we are a quantitative firm, and that means we rely most heavily on math. We don't rely on opinions. We have models that are all mathematical. So you might call it paint by numbers. Here's what the algorithm says we do, therefore that's what we do. It really doesn't matter how we feel about it. And our experience has been that when we can get the emotions out of it and make adjustments based on the facts, we know it's not going to work out 100% of the time. That's part of the fact set we work with. But we do know that it tends to work better for us because those emotions that we have tend to often work against us. As an advisor for over 2.5 decades, almost 3 decades now, I've found that most people want 3 things. They want to comfortably reach their goals, they want to participate in the ups, and they want to minimize the downs. And that's why we've engineered things the way we've engineered them. Study after study has shown that financial advisors, on average, tend to add 1 to 3 percentage points to the outcome that clients get. So clearly there's an advantage in having an advisor. Study after study has shown this. Study after study has also shown that the average stock market investor, including those that aren't using an advisor, tend to radically underperform the stock market. And we think a lot of that is because of the way decisions get made. And so that's the reason we've interjected math to try to make those decisions mathematical, factual based, instead of based on opinions. And my dad used to have this saying that I won't repeat about opinions, that everybody's got one. We think there are 3 key principles at work in having a successful investment experience. Number 1 is we start at the top. Asset allocation is the highest impact decision, and that's where we need to start. Number 2, having a plan. There is tremendous power in having a specific plan for what you'll do when things go right, precisely what you will do when things go wrong, because inevitably they will from time to time. The third principle is to manage risk, because we all know offense wins games, but it's really defense that wins championships. So your financial advisor knows this. He's utilized this in the plans for all of us on the call. Asset allocation has the biggest impact on what happens. That's why in our fund and in all the things we do, we focus on the asset allocation. To us, it's more important what group of investments you're in as opposed to specifically the security, because that tends to have the biggest impact. Number 2, having a plan. Plans have to be dynamic because risk is dynamic. So if the road is clear,
This
120 years
conference
or
will
so.
now be recorded.
We still good, Marty?
Yep.
Okay. The green vertical lines show the times that the market is actually creating new wealth. And so you end up seeing this 80-20 rule at work. You see that in a lot of places in life. So whether we look back the last 5 years, the last 25 years, the last 105 years, we see that the market goes through these different periods where it makes new money and then it's declining and recovering from those times. So what we do is we use math to try to make those decline and recovery times shorter and easier to deal with. And it's not just U.S. stocks that do that. It's international stocks, real estate, commodities. They all have times where they are productive, and then they have the majority of time where they're not productive. So we've got these three principles at work. Start with the plan, focus on the asset allocation, and then make sure that we're really managing risk. So if I can figure out how to stop sharing screen like that. So what does that mean for us today? That's kind of the background. We've seen some changes already that already started taking place last year. And one is the theme that we call growth over value. It seems counterintuitive. The kind of traditional wisdom says, well, you buy dividend stocks so that you get paid those dividends even when the market is going nowhere. And there's definitely some logic to it. But if we look at what's happened actually in the markets, and it's been exacerbated really in the last 2 months, that the S&P 500 growth sector year to date, as of earlier today, was down 2.89%. The S&P 500 value sector is down 22.43%. So you see this huge divergence. In the last 10 days, the S&P growth sector is at a 0% rate of return, and the value segment is down 7%. In the last 30 days, the S&P growth segment is up 3%, and the value segment is down 4%. So you've really seen this growth over value accelerate. In fact, it's been a decade since there's been this much divergence between growth and value. So that's one of the things that is a theme of ours. The other is large over small. Don't mean to step on any toes, but we'll just the way we say it is, you want to. Some of you, like me, might be old enough to remember a anti-drug campaign that a first lady came out with. That was their theme was just say no, and that's what we say to small cap stocks right now. Just say no. So the small cap stock index is down about 36% this year. And so one of the things that we endeavor to do is what we call the elimination effect. And that is sometimes it's not what we put in the portfolio, it's what we leave out. So by leaving out small cap, by leaving out energy, by this year we began leaving out real estate. Those things have helped the decline be less than the overall stock market and help the volatility be lower. So going forward, I think we'll see definitely some changes in the economy. We've got companies that are beginning to realize that allowing people to work from home or work remotely, maybe not all the time, but 1 or 2 days a week might actually make some people more productive. that is going to be a boon for, and continue to be a boon for, a number of technology companies. I think that has a long-term impact on real estate, and we've already seen REITs, the REIT index, publicly traded REITs I'm referring to here, take a hit because most real estate, large real estate companies are not collecting 100% of the rents that are due them, whether they're in commercial, whether they're in multifamily, whether they're in retail. So the ones that are collecting with the triple net leases, those will be at a premium. So I think we already had seen some of this, some of these hints. The growth over value, the technology stocks over the kind of the old economy stocks that had already been taking place. The market has recovered that since its lows back in March, and has recovered actually quite well. The S&P recovered almost 62% of its decline. From its peak to its trough, it recovered almost 62% of that decline. And statistically, in the amount of time that recovery happened, that is almost unheard of in the recovery period we have had. And in fact, on April 29th, the S&P 500 got to a point above its short-term moving average that has only happened 72 days since 1950. In other words, it was so extended, it had gone so far so fast that 99.59% of the time, it never gets that high above its short-term moving average. So we use those kind of numbers to say, well, if it's moved that far, that fast, then the risk is very high. The road has turned from a clear road to a snowy road, at least in the short run. And, you know, if the odds are 99.59% against us, it's going to be hard to win. And so, you know, there's an old saying, the battle doesn't always go to the strongest or the race to the swiftest, but that's always the way to bet. So our perspective is looking at medium-term and short-term trends that are likely to evolve into long-term trends that stay in effect. So we haven't liked energy for 18 months. We haven't liked small cap stocks for 5 years. We haven't liked real estate for a few months. And having said that, long term, we are very optimistic about the U.S. economy because there are so many segments that are so robust, number one. Number two, Americans had such a great cash position going into this, and consumer debt was at a very reasonable level given historical norms. So we don't think that we don't look at the U.S. market as being overvalued or undervalued. We just look at it as, does it have high risk or low risk? And at this point in time, on a long-term basis, it looks to us to be right in the middle. On a short-term basis, you know, since April 29th, it's looked a little higher risk. Some of the lower risk areas, which again is kind of counterintuitive given kind of the traditional thinking. We think actually international markets and emerging markets appear to have less downside risk. So that's kind of given the numbers that we're seeing, our outlook, and I'm almost 20 minutes in. So, Marty, are there any other specific areas you'd like for me to address, or themes that it would be good to cover?
Sure. So, as far as sectors, you touched on tech. I think we can say you like technology at this point.
Love it. Love it.
And we touched a little bit on energy. I think this is a just say no.
Just say no.
Yeah. What are you thinking about healthcare right now?
Well, healthcare is interesting. It's actually held up really well this year, so we like it. We are going to see some problems if you drill down specifically, because hospitals, particularly smaller hospitals, rural hospitals, have they're in a hurt. Most of them are leveraged very highly. You have elective procedures that have been put on hold. What eventually will happen, and probably before the year is out, those elective procedures will get done, because either they become mandatory if a state's still shut down, or when things open up, the floodgates will open. So it's going to be. We're already seeing this. We just opened 2 weeks ago here in Tennessee, and dentist's office opened a week ago. You can't get a dental appointment in the next 6 months, because they were shut down and everybody's rescheduling. So same thing with elective surgeries. So we think longer term that's going to be a really positive place to be, but there's going to be a big hit for a quarter on earnings.
Okay. So would you comment on the bond market? What do you see there?
Wow, that's a tough one, isn't it?
Yeah.
When you see interest rates getting to this level, who thought you could see an interest rate below 3% on a 30-year Treasury bond? Who thought it would be below 2%?
Right.
And now here we are. And so my concern, and I don't think it's a concern in the very near term, although on the longer end of the spectrum, there's some risk. I'm just concerned about the risk. So how we're addressing the bond market is high and short. Stay with high quality, stay short term, high and short.
Okay.
To avoid getting hurt. And the thing of it is, there's just not much yield differential right now between that short end and the 30-year. But it's and even those intermediate terms, which we've traditionally gone to really mitigate risk and provide some yield, there's just so very little yield there to be had. And the Fed doesn't have to move for interest rates to tick up a little bit in that interim. The Fed really just has control over the short-term rates.
Okay. So last couple days, the market has not been kind. So this question came in earlier in the weekend, and it's about, is the market overvalued at this level?
The honest answer is I don't know, and neither does anybody else. And that may not be very helpful, but what I would say is it is in a right now in a range. We would expect to see 6% up, 6% down from here for a little while. We need a few weeks to digest this big move we've had off the bottom, and and see some results come in, there's so much that's hinging upon how quickly do companies get ramped back up. I mean, I think if we fast forward a few months, everybody's gotten ramped up, but the question is how much of a drag is in there, and I think that's where we're hitting this short-term ceiling that we've seen. You know, the S&P hit it almost 3 weeks ago, or 3 weeks ago, and has continued to bounce up against that and can't seem to get above it based on the outlook on earnings. And it's going to take a little more clarity on earnings to be able to see that. I think we've seen the low in the market. I don't think, from the way our indicators look, I don't have a concern that we're going to go back and test those lows. My concern is I just don't know how much higher we can get until we get more data in, and that's going to take 6 or 8 weeks. Okay. So I think we're in a range right here with the U.S. stock market.
Okay, so if we say within a range, plus or minus 6%, for a couple months, so through the summer, something like that. Then right after that, we're going to have an election. So given everything that's gone on, we can talk about historically what's happened in election years. Do you think it will be as volatile with the election, or do you think perhaps not? Look in your crystal ball, Greg.
I mean, I don't see this election being any less volatile than others, and we all know historically there's this anxiety that comes up to elections. It usually ends up being concern. I mean, we all have deeply held values and beliefs, and those get expressed oftentimes through our politics or our affiliations. But how it actually affects and impacts the economy, we've done studies on this on 3 months, 6 months after the election of a Republican and a Democrat, and basically what it comes out to is it ends up generally being a non-event. So maybe it's different this time. Obviously, this COVID-19 is a different factor, but the election on its face, I don't know, I don't think that's going to be the biggest driver. As we get 6-8 weeks out from the election, that's when the election volatility really sets in, and we probably will have some of that. And I think it's important for us as investors to understand, all of us, whether we're an investment advisor or whether we're clients, we all have money at work, to understand that there's going to be some volatility, and also understand that we need to make some adjustments. But ultimately, who ends up in the White House is not. I mean, that may be really unpopular to say. I may be stepping on toes, but look, we can say that France is a socialist country, but the last 30 years, their stock market's done as well as ours. And we can say, that the rule of law, given the crime in Mexico, is probably the rule of law is not as prevalent in Mexico, and yet the Mexican stock market has outperformed the U.S. stock market over the last 30 years. So who is in the White House is not ultimately going to impact whether or not we're successful as investors. We've got to do, and Marty, I know all the financial advisors associated with you all are working hard to make sure those decisions are being made regardless of who ends up in the White House.
Yep. That is always a discussion.
It's always a discussion, and you and I have been doing this long enough. I heard that the world was coming to an end if a Bush got elected, and the world was coming to an end if a Clinton got elected, and the world was coming to an end if another Bush got elected, and if Obama got elected. And interestingly enough, we're all here
Right, right,
still.
right. So if we could just keep calm and move forward, it would be nice. So as we look towards in Wisconsin, we have a stay at home orders until May 27th, and now we're all trying to figure out how this reopening, is going to work and feel and everything else. So as we go through that process, and if there's a resurgence of COVID-19, that obviously won't be good for the markets. But can you shed, some of your insights on that scenario?
One of the things that I mean, obviously, I'm not a I started to say I'm not a herpetologist. I'm not an entomologist, or any other kind of ologist. But one of the things I found really interesting is in Sweden, which didn't go through a lockdown. In Stockholm, the Minister of Health shared that it's now about 5 weeks ago they tested, and 10% of the population in Stockholm had built up antibodies to COVID. When they did the same study 3 weeks later, that number had grown to 25%. So what that appears to suggest is, and if you even look in, what's going on with the numbers in Italy and some of the countries that seem to be ahead of us, the numbers seem to be going down. It seems to suggest that possibly like the flu, that there is some sort of immunity that is developed over time. But if we have another wave, we'll do what we can to figure it out. I think one of the things that has been helpful is we've had a shot over the bow, right? So we've had this warning shot to say, look, we all need to be prepared in how do we continue to live, operate. Much like you're doing with this. You've got a webinar. You could be having people in for lunch or hors d'oeuvres, but you're doing this virtually. And so, that's one of those hypotheticals that I don't think anybody has an answer for. And I think we can be aware, but I think if we focus our attention on that, we end up missing the opportunity that is going to be presented right in front of us. And I just think there's been so much chaos from this, and there will be businesses that go out, and it will create so many new opportunities. I mean, we're already seeing it. People that are starting businesses now because of the opportunity that's created.
True.
I don't know if that may not answer the second wave, but we don't have a cure for all the other COVIDs that or coronaviruses that are out there. There are a bunch of them. We don't have a cure for influenza, and yet we go on and operate. Hopefully, we'll have some more effective ways to mitigate its impact. But right now, it doesn't seem like anybody really knows what that is.
Yep. I think your point is valid. If something, right, if there is a resurgence, we know how to deal with it. This isn't the first time. This isn't like February and March where we thought, oh my God, what in the world would we do? We know exactly what we would do, right? So
right.
You can, that's valid. Okay. Yeah. So what, when we dig into this a little bit more, we've got, clients that are utilizing the Luken strategy. What are some of the changes that you made during April and May?
Well,
Can you help understand what's gone on with your portfolios?
yes, I can speak in general. I know you can appreciate this. I'm warned by counsel that we can't disclose anything that's not publicly disclosed about current fund holdings, but you can look at the performance and infer that um, at some point during the decline, we got a little more conservative because we declined less than the S&P. We declined a lot less than the international stock market, a lot less than the small cap. We had already been focused on growth over value, large over small, had already eliminated energy and real estate, um, and um, and you can infer from my comments that I said that April 29th, the stock market got extended up to a level that it only gets to, um, you know, 0.41% of the time. So at that point, the risks seem high. So you might infer that we got a little more conservative then. We still like emerging markets. We still like international markets. We still like the NASDAQ. We like those large growth companies that, you know, the third week of March, more people signed up for Microsoft Teams, which is kind of like a go-to meeting platform that's part of Microsoft's platform. So they signed up for this additional subscription than had been total subscribers of Slack. So you look at companies like Microsoft really have benefited from this time.
Yeah.
Companies like Walmart, Amazon, those companies have actually benefited through this. Grocery stores.
Yep.
There's a lot of segments, and I think one of the things that's really interesting in talking to people all around the country, Marty, is that where we are tends to have a huge impact on our outlook on what this looks like. So we're based in the Nashville, Tennessee area, and we talk to people all over the country. So if I talk to somebody in Alabama, they had a, hey, stay-at-home order if you feel like it. And the economy's kind of gone on, and they haven't had a huge outbreak. And then you have some place like Wisconsin or Minnesota or New Jersey or New York, and people, I mean, justifiably, it's understandable. They're in, it seems it's got to be scary, and so I think so much of that really the outlook we have on it depends on where we are, and so it's difficult to say the actual impact it'll have on the economy. And even places that shut down, I don't know about there. I know in Texas, when they did a shutdown order there, it included construction for about 4 days until whatever lobby made enough noise. They say, okay, well, construction is essential services too. So, so there's a lot of areas of the economy that have continued to move forward, and the stimulus package, the PPP, we've got so many people on unemployment now, and this is not a political statement. It's just a statement of fact that the accelerated unemployment benefits made it so much more profitable for people for 4 months. For many people at the bottom of the spectrum, they're actually better off during this time financially.
Right.
One of the local hospitals, the nurses now have to clean all the rooms because the staff that cleaned the rooms all quit because they said, we can quit, make more on unemployment for 4 months. And the unemployment offices are so overloaded, they'll admit if you want to get your dog on unemployment right now, you can. I mean, it's going to be fraught with fraud. But that's just the reality. So you have people that are actually better off financially than if this COVID thing hadn't happened. So there's so many layers to this, and it's so complicated. I think to say that this is the end of capitalism or the American economy as we know it is just we don't see it. I'll say this, in Tennessee and in Georgia, it other than the retail, and they're still doing some of the social distancing in retail and restaurants, it doesn't look like much happened.
Really? So here in Wisconsin, it looks and feels like something happened. It does.
Well, this I know, because I talk to people in Wisconsin all the time, and it just and so that's what I'm saying is that shades so much of our outlook, right? So if I see it, everybody around me says, well, it doesn't seem like much happened, and everybody around you says, yeah, a lot happened. You and I are going to have very different perspectives on what this looks like. So I just think we are. There's nothing that's been modeled about this COVID-19 yet that's been correct, just in terms of the spread of it, or how we deal with it, and we don't know the exact impact of these financial measures. The stimulus checks, the PPP, the unemployment. I talk to business owners all the time. They say, I don't know where all these people on unemployment are because I've got so many positions I can't fill. I can't find people. And it really is an unprecedented situation. I think things will look. My belief. I don't need to share my belief. It doesn't matter. It's my opinion how things will look later in the year. But the way our indicators appear, short term, next 6 to 8 weeks, I wouldn't look for the stock market to go up another 18 or 20%. Wouldn't be my expectation. So managing volatility, keeping volatility low, building positions in those things with lower downside risk and that are likely to benefit most from the recovery. And I think those technology stocks are likely to benefit a lot. I think we'll get a big bounce back from some of the smaller stocks, regional banks. Banks are going to get paid a lot of money through this government stimulus package, and that's not reflected in there right
now. Okay. So one last question for you, Greg. What's looking into your crystal ball again? What do you think is going to happen with the cruise industry?
I would put that in the same camp, probably even more so in the just say no camp. I think it's going to be really difficult for them due to debt levels, due to infrastructure costs, and due to have you scheduled a cruise here recently, Marty?
No.
No, and I don't know anybody else who has either. So that's my concern. I think when there's time for it to shake out, there will be opportunities, and clearly, those biggest players are going to be the ones that survive, and they'll probably end up buying the assets of the more leveraged players. But I just think we've got too far to go for that to recover to start looking at that as an opportunity yet.
Okay.
I mean, people are going to continue to go on cruises, but probably not this summer.
Right. I think it's interesting to see, some of the cruise lines are saying that they're starting to book for cruises this summer when we still have cruise ships out there with thousands of employees who they won't let off the ships. Seems
Right.
like there's an issue going on there.
There is an issue going on, and it's, you know, it's there's this term creative destruction, where, you know, you go through a time like this, and there's a lot of pressure on cruise industries. There's a lot of pressure on a lot of oil companies right now because a lot of them have a lot of leverage. And but what ends up happening is the ones that are levered the most or the most financially on the brink go out of business, and their customers are acquired by those who are left. And so it's, for those companies, it's bad. When you look net for the industry, and fast forward 2 years out, it's probably back where it was, but it may be that the money for the cruise, from the cruise customers, may end up in fewer hands.
And
But I just think it's a little too early for us to go fishing in that pond.
Yep. Okay. Thanks. Well, Greg, thank you so much. As it's your insight is great. Love the dialogue and really appreciate you taking time out to join us on the call. And I'd like to thank, oh, wait a minute. Does anybody in the audience have any other questions they'd like to pose to Greg at this point? Jess, have you opened up the lines?
I did. Should be open.
Okay.
All right.
Sounds like.
Well, Marty, that
okay.
sounds like you ask all the right questions and ask the questions for everybody. So appreciate that.
Well, I appreciate your time that you've spent with us today, Greg. I really do. And I'd like to thank everybody else who's joined us on the call. And we look forward to you joining us next week, where we'll feature the thoughts and insights from John Adams and Mike Dodal maybe, from BMW Global Asset Management. Webinar will be on Wednesday, the 20th at 3 o'clock. And as always, we really appreciate your trust and confidence that you place in us. And we're going to continue working through this. Please contact your advisor if you have any further questions or comments. And we look forward to grouping with you again next week. Thank you very much. Bye.
Thank you, Marty.
Thanks, Greg.